Welcome back to Lipper's Fund Flows Insight. I'm Jeff Turnahoy. For the week ended October 30th, 2013, the conventional mutual funds industry saw flows activity heavily tilted toward cash and equity funds this week. So let's take a look at our asset classes and see where the activity was. Starting off at the top, equity funds had about $3.1 billion in inflows. Taxable bond funds took in a respectable $1.2 billion. Municipal debt funds continued to bleed assets. This week, just $600 million was removed from them, and money market funds took in about $7.7 billion. Well, as I said, most of the activity was tilted toward cash and equities. Overall, this week, we saw some interesting news that shed light on a softer economy. This was part of the bad news is good news perspective that investors have had for some time now, expecting that softer economic data will keep the Fed interested in more stimulus and won't remove the punch bowl before everyone's had their fair share at this party. So this week, $3.1 billion came in. Again, it's the third week of inflows for equity funds. The market was only up about 41 basis points, but that belies some hidden truths, such as many of the favored benchmarks like the Dow Jones Industrial Average hit new closing highs during the week. So there's still a lot of momentum in this market right now. We had, again, mixed economic news, but that didn't stop investors from taking chances. In fact, it probably encouraged them to do so. Emerging market funds was one of the week's best gainers this week. They took in about $457 million. At the other end of the spectrum, large caps continued to bleed assets. Investors yanked over $700 million from them. Overall, investors seem split between domestic and non-domestic. The winner of this week was non-domestic. They took in about $1.7 billion, while domestics took in about $1.4 billion. So investors are mostly looking overseas for their equity exposure right now if given a choice. Now we should take a look at equity ETFs. Investors there weren't quite as committed. They put about $1.3 billion to work in their products this week. Top gainer this week was SPY, the S&P 500 Trust. It took in about $1.3 billion. So logically, if we remove that one, the rest of the ETF industry was pretty flat for flows this week. But we'll move on. IWM actually took in about $1 billion this week. Another good one was EFA. That took in just about $700 million, call it $800. At the other end of the spectrum, though, we saw GLD. It had about $425 million in outflows this week. Also, Japan and China plays also suffered outflows. The next group we'll take a look at is taxable bond funds. They had, again, about $1.2 billion in inflows this week. Investors probably took notice, at least if they were Edward Jones clients, of a new product out there called the Bridge Builder Fund. Interesting note about that. We see here that multi-sector income funds took in about $3 billion, while core bond funds had outflows of $3 billion. It turns out this new product from Edward Jones is a multi-sector income fund, and a lot of its advisors had put money to work in a similar JP Morgan product that was in Lipper's core bond funds group. So over this week when it debuted, they shifted money from one account to the other all at once. So there we have it. It's a little bit of a bubble in the data, but it has some logical explanation. Now, other groups should be discussed as well. We saw high yield funds take in modest amount of money this week, about $249 million. At the other end, mortgage bond funds, such as Double Line Total Return, they had outflows this week. Total in that group was about $246 million in outflows. Well, let's turn now to fixed income ETFs. They had fairly flat flows data for the week. They still have 2 weeks of inflows. However, most of the activity was fairly muted. The iBoxx High Yield took in about $186 million and was followed by the MBB and FLOT products with about $160 million in inflows. At the other end of the spectrum, we saw TLT, which is the 20-year plus Treasury ETF, suffer outflows of about $430 million for the worst flows activity this week for these funds. Overall, light flows, as I said, the net was about $70 million, so given the size of this group, it was probably pretty flat. Next group to take a look at is the ever-suffering municipal debt funds group. They had about $600 million in outflows this week. This is the 23rd consecutive week of outflows, taking their year-to-date outflow totals to $46 billion, clearly their worst spate of outflows ever. Outflows are decelerating here. We can see over the last couple of weeks that they've gone from about $1.2 billion out to about $600 million out. They happen to be the best performing group this week. And in fact, the last 2 weeks they put in some very good performance as well. So perhaps there's a little bit of momentum out there. We've got probably one group of muni debt investors just not convinced that things are going to turn the corner. Others may be starting to value municipal debt as an interesting play because it has been beaten down so badly this year. The final group to look at is money market funds. They had inflows of about $7.7 billion this week. Fairly different views on cash this week between institutional and retail investors. On the one hand, institutions wanted to put some money to work, keep the powder dry, I should say. They put about $14.1 billion in their cash accounts this week, while retail investors took money off the sidelines. They put money to work this week. They took about $6.4 billion out of their cash accounts. So overall, modest flows on a net basis for money market funds, but again, a real split between institutional and retail investors. Well, that'll do it for flows analysis this week. Please join us again next week where we'll talk about the flows activity among mutual funds and ETF investors. Feel free to reach us online at lipperusfundflows.com, and we will see you next week. Thank you.